Yo, what's up guys? In today's video, we're going to be going over the options contracts that I like to take and when I am choosing these contracts for my breakouts. So there's going to be two parts of this video. I'm actually going to show you on Robinhood after I explain it on how to actually pick it to make it super easy for you guys. So watch this whole video. This is going to give you a really good understanding on how I pick my contracts. So let's jump straight into it. You guys already know when I'm choosing my contracts, right? So we're going to talk about out of the money versus in the money. Out of the money contracts are cheaper for one, so that's why I like to take them because I can pick more contracts and they give you a bigger percent return if the breakout actually works and then ends up getting into the money. It is a little bit riskier. It can be a little bit more volatile, but the percentage that you can make out of a stock like this can go exponential and it can make you a lot of money. Now, in the money contracts, they do cost more, so they're more expensive and they're less riskier. They move pretty slow with the stock price, so they're not as quick. They're more safer. So just a really simple explanation, you know what I mean? Out of the money versus in the money. Out of the money, you can get a huge percentage gainer. It is a little bit more riskier and the contracts are cheaper, so they can go to zero quicker. But that's the contracts that I pick, especially because, you know what I mean, I'm looking for big percent gainers when I am trading. So yeah, that's really all it is. I personally use out of the money for my momentum breakouts, and I'm going to get into that later into this video and show you how to pick these expirations. Now, the expiration part of it, right? The weeklies, now let's say if it is August 1st, right? If you're going to pick August 7th expiration, August 6th, right? That's a weekly expiration. That means that your contracts expire at the end of that week. That means that you only have a week, which isn't really that long. So usually if I'm picking weeklies, it's because I'm trying to get a quicker percentage gain more fast, or I'm going to day trade a breakout, which I don't do pretty often, but I do it sometimes, and I would pick weeklies for that because they're more volatile, they are more riskier, and if you are picking a weekly expiration, obviously they're going to run quicker, upside and downside, so you can get more out of it. Now, this is my sweet spot, the 2 to 4 weeks out for most of my swing trades. I'm usually picking, you know what I mean, 2 weeks to a month out. It gives my trade some time to actually play out, right? So if we give an example on HIMS, I actually took this breakout down here and it was all the way down here. You can see this base breakout and I'm still in it. I'm up about 100%. I took actually 2 to 3 months out on this and it's been going up ever since. I've been holding this swing trade and I'm up 120%. It's just a position that continues to make me more and more money. So I would say, you know what I mean, 2 to 4 weeks is like the sweet spot. And that's usually, you know what I mean, where I'm looking for that big run on a stock for a swing. I'm looking for that first week or two to see a really nice move. So if we look at a stock like Tesla, I took this breakout all the way down here. I think I took 2 weeks out, so you could see for that 2 weeks, it just kept going higher, and then I sold up here. So 2 weeks to a month, perfect sweet spot for picking your expirations. Now, 1 to 3 months is if it's a slower mover. So let's give an example, like United Health Group right now. We're pretty undervalued down here, and I think that this breakout looks good, right? So I took a couple months out on this position right here, and it's pulling back to my breakout level, so I may get stopped out. But when you are picking 1 to 3 months out, they're super slow. So like you could hold this and I could cut a loss at 10% and barely be down anything. So, you know what I mean? I'm looking for more of an exponential move over that 1 to 3 months, and it's more of a slower mover. But the 2 to 4 weeks is the main expiration that I'm usually taking, 2 to 4 weeks out of my contracts. Now, I want to give the trade enough time, so obviously theta doesn't just clap my contracts right away. If you don't know about theta, I would go watch like a super beginner options trading video. Theta is just time decay. It devalues your contracts, and your contracts start to devalue as time gets closer to the expiration. So that's why I do like to give my positions some time when I'm taking them. Now, my process for when I'm picking these trades, right? I like to look at the chart. I like to look at the setup. I like to analyze what I'm thinking, whether this could run for months or if I think that it could be a nice weekly, 2-week out breakout. Then I pick my contracts that I like, whether that's a 2-week contract, 3-week contract, and I'm going to look at the contract's volume and open interest on that strike price, right? So I'm going to look at the contract and I'm going to see, okay, does this have really low volume? Is there not a lot of liquidity in this contract? Does it have open interest? You know what I mean? Are people even interested in these contracts? Are they moving, right? That's the number one thing. Then I pick the expiration. That gives me enough time for the trade to work, and then that's when I'm entering. Obviously, you want to align the strategy criteria. So like you want the stock to actually be breaking out, and then you go through this whole process. So that's really all that I'm looking for, right? You know what I mean? On stocks like, let's say Tesla. Like Tesla's actually breaking out today. If this breaks out, I'm looking for like 2 to 3 weeks out, because I think that 2 to 3 weeks, this could just keep going higher and higher and higher. And you want to make sure that you're getting that whole move. You don't want to take a week out expiration, cut it right here for 100% gainer, 200% gainer, and then it runs 500%, right? So it's very important to realize that expirations are a big part of your trading, and you don't want to pick too little of an expiration, like a week out, and then have the stock run a freaking 500 more percent. And you know what I mean? You're going to miss out on a lot of gains. Like, let's give an example on STX right here. All the way down here, man, this is the biggest FOMO ever. I took a weekly out expiration on this breakout down here. I don't know if you could see on the screen. And I sold right here. And now look at the stock. This is where generational wealth is made, and this is how you need to hold your stocks. So I should be up 3 Lamborghinis, but I didn't. So that's why it's important. If I did pick, let's say, a month out expiration, I would have held this the whole entire month. So that's why it's important to analyze the situation and take those trades based off of, you know what I mean, the thought process of what's going to happen with this stock. What do I want to see? Where are my targets? And yeah, hopefully that makes sense. Let's get into the next part of the video where I'm showing you on my phone and on Robinhood how I am choosing these expirations. Let's get into it. For the people watching this course, I'm going to give you a tutorial on how to place these trades on Robinhood, and that is for very, very beginners. Most of you guys probably already know how to do this, but for the people that truly do not know how to do it, I'm going to help you out. Can I make a video, bro? All right, so this is how you are going to search for stocks. Bottom right, obviously you're gonna put money into your account and everything. You're gonna deposit money, and you start off with like $1,000, $5,000, however much you're willing to start off with. But that's not the point. You figure that out yourself. This is what the most important thing is. Let's say we want to trade Tesla, right? You're gonna search in the search bar Tesla, right? It's gonna pop up, bang. This brings up the Tesla stock. You can see Tesla is trading at 425.50, and you can see all this extra bullshit, right? The main thing you're going to focus on is trade. This is where you're going to pick options. So you press trade, and then you click this beautiful button right here. If you can see it, it says trade options, bang. This is going to bring you to the options expirations. So the options expirations are up here. Let's say that I'm picking the October 3rd contracts. You're going to pick October 3rd. Now, boom, what is this? This is called the options chain. In the middle right here, that's going to be your share price. These are the out-of-the-money options contracts. These are the in-the-money. That's if you're trading calls. If you're trading puts, switch over to puts. Now, this is in the money. This is out of the money, right? Super simple. I usually trade calls for the most part, bro. You get away from me, bro. Damn. I usually trade calls for the most part, so super, super easy, right? Now, let's say if I'm like, okay, I want to pick the $430 calls. You click it, you click buy. That's where you could see all the open interest, the volume, the theta, the fill, all this good stuff, right? You're going to press buy, and then you see, cool, buy Tesla, $430 calls for 10.3. That's the expiration, right? Now, you can obviously see the limit price. This is usually when I'm trading. I don't trade like anything else like market or any of that stuff. I just trade limit, and I'm usually just trading the ask. So let's say if I wanted to buy 5 contracts of Tesla, I hit 5. The total cost of that would be $8,000, as you can see, because each contract is worth $16.80. So that means one contract is worth 100 shares. $16.80 times 100. What is that? 1,600, right? So you can see the estimated cost for one contract is 1,600. So if we get 5 of those, that's going to be 8,000, right? So then you would press review, and then you would swipe up. I'm not going to buy that, obviously, because I do not want to buy a random stock. But that is how you buy options contracts. Hopefully that made sense for you guys. Super, super simple.